On July 5, 1991, regulators in 69 countries simultaneously seized the assets of a single bank. A coordinated shutdown so precise it had been rehearsed in secret for months. And what they found inside the accounts was not just fraud, but the complete financial infrastructure of the CIA's deniable operations for 2 decades. And the question that the Senate investigation would spend 3 years trying to answer was not how the bank had hidden all of this, but how many American officials had known and said nothing. The morning of July 5 began before dawn in the time zones that mattered most. In London, officers from the Bank of England arrived at the headquarters of BCCI on Leadenhall Street in the city at precisely the moment that regulators in Luxembourg, in Hong Kong, in the Cayman Islands, in Frankfurt, in Paris, and in dozens of other financial centers were doing the same thing at their local branches. The operation had been coordinated across agencies, across governments, across legal jurisdictions, with a level of logistical precision that is unusual in international financial regulation, and that itself raised questions that were never fully answered, because coordinating 69 simultaneous regulatory actions requires months of preparation, and months of preparation means months during which the people being investigated could have been warned, and the fact that they were not warned, or at least not warned effectively enough to move the money in time, was either a testament to extraordinary operational security or evidence that the shutdown had been permitted to proceed by people who had decided that protecting what was inside BCCI was no longer worth the cost. The doors closed, the accounts were frozen, the staff were told to stop processing transactions and wait for instructions from the authorities. In branch offices across Asia, Africa, the Middle East, and Latin America, ordinary depositors arrived that morning to find their bank inaccessible. Small business owners who had accounts at BCCI branches in Pakistan and India and Bangladesh. People for whom BCCI had been the primary financial institution serving immigrant communities in Britain and elsewhere. People who had chosen it precisely because it served populations that the major Western banks had historically ignored, found that their savings were locked behind closed doors. They stood outside and waited for explanations that did not come, at least not in any form that told them what had actually happened or where their money had gone. The official explanation arrived quickly and had the clean lines of a story that had been prepared in advance. BCCI, the regulators announced, had been engaged in massive fraud. Its accounts had been falsified. Its capital had been fabricated. Its management had been running what amounted to a criminal enterprise disguised as a banking institution. The closure was necessary to protect depositors and the integrity of the international financial system. The losses were substantial. Early estimates ranged from $9 to $15 billion, though the final accounting would take years and the true figure was never definitively established. What was certain was that 1.4 million depositors around the world had money in accounts that were now frozen, and that a significant portion of that money was simply gone. This explanation was accurate as far as it went. It did not go very far. What the official explanation omitted was a set of facts that had been known, in varying degrees of detail, by American intelligence and law enforcement agencies for the better part of a decade before the doors closed. It omitted the CIA accounts. It omitted the covert operation funding. It omitted the 5 years during which the Justice Department had actively worked to limit the scope of the one investigation that might have exposed what BCCI actually was before the money was gone. It omitted, most specifically, the contents of a CIA internal report from 1986, a report that Director Robert Gates would acknowledge before the Senate, under oath, 5 years after the shutdown, which had established that the agency was aware of BCCI's criminal activities and had chosen, for reasons that were characterized as operational, not to share that information with the regulatory authorities who might have acted on it. Robert Morgenthau, the Manhattan district attorney who had been trying to investigate BCCI since 1989, heard about the July 5 shutdown on the radio. He had been fighting for 2 years to obtain documents and cooperation from the Justice Department that would have allowed his office to bring charges against BCCI and the people who controlled it. For 2 years, the Justice Department had offered reasons: procedural, jurisdictional, operational, why Morgenthau's investigation should be circumscribed, delayed, or conducted differently than he intended to conduct it. For 2 years, the information that would have told him exactly what he was dealing with had been sitting in files at Langley that no one in his office had been allowed to see. When he heard about the shutdown, his response, according to people who were in his office that day, was not surprise. It was the specific and controlled anger of a prosecutor who had spent 2 years being managed by people who knew more than they were telling him, and who had just watched the evidence he needed disappear into a coordinated international action that he had not been consulted on and could not have stopped. He called his investigators into his office. They had work to do. But to understand what Morgenthau was actually dealing with, to understand why the Justice Department had spent 2 years making his investigation difficult, and why the CIA had spent 5 years not telling the regulators what it knew, and why 69 countries had needed to move simultaneously to close a bank that had been operating criminally for at least a decade. You have to go back to 1972, and to a Pakistani banker with a vision, and to the specific architecture he designed to make that vision impossible to regulate. Agha Hassan Abedi was not a criminal in the conventional sense. He was something more difficult to categorize, a man with a genuine institutional vision, an extraordinary talent for cultivating relationships with powerful people across cultural and political boundaries, and a specific understanding of how the international financial system worked that allowed him to design an institution that exploited every gap in that system simultaneously. The criminal enterprise that BCCI became was not a corruption of his original vision. It was, in important respects, the fulfillment of it. Abedi had been born in 1922 in Lucknow, in what was then British India, into a family with Sufi religious traditions that he carried throughout his life in a way that shaped both his personal style and his institutional philosophy. He was educated in law and entered banking in Pakistan after partition, rising through the United Bank of Pakistan to become its president in the 1960s. He was, by every account of people who worked with him, a man of exceptional personal magnetism, someone who could sit across a table from a head of state or a village banker and make each of them feel that he understood their specific situation with unusual depth. This talent was not incidental to what BCCI became, it was the mechanism of its construction. In 1972, Abedi left United Bank to found a new institution. His stated vision was explicit and in its own terms coherent. The developing world needed a bank that served its interests rather than the interests of the Western financial institutions that had dominated international banking since the colonial period. A bank headquartered outside the major Western financial centers, capitalized by the new oil wealth of the Gulf states, serving the trade and development needs of Asia, Africa, and the Middle East. This was the pitch Abedi made to Sheikh Zayed bin Sultan Al Nahyan, the ruler of Abu Dhabi, who provided the initial capital of $5 million that brought BCCI into existence. The vision was not entirely cynical. Abedi genuinely believed that the existing international banking system was structured to serve the interests of wealthy nations at the expense of poorer ones, and he was not wrong about this. His bank did, in its early years, provide financial services to populations and businesses that the major Western banks ignored. Pakistani immigrant communities in Britain, small traders in Africa and Asia, governments in the developing world that could not access international capital markets on reasonable terms. But the structural choices Abedi made in designing BCCI were not simply the product of development banking philosophy. They were the product of a specific understanding of regulatory geography, of the gaps that existed between national banking supervisors when an institution operated across dozens of jurisdictions simultaneously, and of how those gaps could be exploited to make meaningful oversight impossible. BCCI was incorporated in Luxembourg and the Cayman Islands simultaneously. This was not a conventional banking structure. Most banks have a single home jurisdiction whose regulator serves as the consolidated supervisor, the authority responsible for examining the bank's overall financial position and ensuring that it is operating safely. By incorporating in two jurisdictions with different regulatory frameworks and different information sharing arrangements, Abedi created an institution that could truthfully tell each of its regulators that the other jurisdiction was responsible for consolidated supervision, while neither jurisdiction actually had a complete picture of the bank's overall position. The Luxembourg Banking Commission, which had nominal responsibility for BCCI's holding company, lacked both the resources and the legal authority to conduct the kind of comprehensive examination that a bank of BCCI's eventual size required. The Cayman Islands, which was the jurisdiction for another piece of the structure, was a secrecy jurisdiction with limited regulatory capacity by design. Its entire economic model was built on providing financial services with minimal disclosure requirements. The result was a bank that was everywhere and nowhere, present in 73 countries, supervised comprehensively by none of them. This structure required a specific kind of accounting to maintain. BCCI's books were not simply falsified in the crude sense of recording transactions that had not occurred. They were managed through a sophisticated system of nominee accounts, offsetting loans, fictitious assets, and treasury operations that moved money between different parts of the institution in ways that made each piece look solvent when examined by a regulator who could only see that piece. Price Waterhouse, which served as BCCI's auditor for much of its history, would later acknowledge that the institution had successfully concealed from its auditors the true state of its accounts for years, a concealment made possible by the fragmented regulatory structure that prevented any single examiner from seeing the complete picture. The losses that BCCI was concealing had begun to accumulate in the late 1970s, primarily through a series of failed investments in commodity markets and through loans made to connected parties that were never intended to be repaid. By the early 1980s, the gap between BCCI's reported assets and its actual financial position had grown to a scale that required continuous active management to maintain, a process that involved fabricating assets, recycling deposits through nominee accounts, and using new deposits to cover the losses generated by old ones. It was at its core a Ponzi scheme of extraordinary sophistication, overlaid on a real banking operation that served real customers with real financial needs. The sophistication of the concealment was not the work of a Betty alone. It required cooperation from a network of insiders, treasury managers, account officers, external lawyers, and accountants who understood enough about what was happening to manage the specific pieces they were responsible for. It also required, increasingly, the active assistance of powerful external relationships that Abedi had cultivated with the same care he had devoted to the bank's regulatory architecture. Those relationships spanned a range of governments, intelligence agencies, and political figures that would have been implausible as a description of a single institution if the documentary record had not eventually established that they existed. The relationship that would ultimately define BCCI's historical significance, the one that explains why the bank was permitted to operate for nearly a decade after American intelligence agencies knew it was a criminal enterprise, was not with any drug lord or terrorist organization or third world dictator. It was with the Central Intelligence Agency of the United States. That relationship began, the documentary record suggests, in the late 1970s. It became operationally significant in 1980 when the Soviet Union invaded Afghanistan and the Carter administration made the decision to support the Afghan resistance through a covert program that would eventually become the largest CIA operation since Vietnam. The program needed money. It needed money that could not be traced to the American government. It needed financial channels that operate across the borders of Pakistan, Afghanistan, Saudi Arabia, and the Gulf states without generating the kind of paper trail that congressional oversight committees and investigative journalists could follow. BCCI was precisely that. It operated in exactly those countries. It moved money without generating the documentation that Western banking systems required. It had relationships with the Pakistani intelligence service, the ISI, that made it a natural conduit for funds moving from CIA accounts through Pakistani handlers to the Mujahideen fighters in the mountains of Afghanistan. And it had Agha Hassan Abedi, who understood what was being asked of him and who saw in the CIA's need for deniable financial infrastructure exactly the kind of powerful external relationship that would make his bank too important to examine too closely. He was right about that for a long time. The Soviet invasion of Afghanistan began on December 24, 1979. Within weeks, the Carter administration had made a decision that would shape the next decade of American foreign policy, produce the most expensive covert operation in CIA history, and create a set of financial relationships whose consequences are still visible in the architecture of international terrorism financing today. The decision was to arm the Afghan resistance. The operational logic was straightforward and, within the framework of Cold War competition, genuinely compelling. The Soviet Union had committed its military to a land war in Asia against an insurgent population fighting on its own terrain. The historical precedents for such wars were not encouraging for the invading power. If the United States could supply the resistance with weapons, training, and money through channels that maintained plausible deniability about American involvement, it could bleed Soviet military capacity and political will without committing American forces to direct confrontation. The program that implemented this decision was given the code name Operation Cyclone. It began under Carter and was dramatically expanded under Reagan, eventually consuming more than $3 billion in American funding over the course of the 1980s, matched dollar for dollar by Saudi Arabia, making it by the end of the decade a $6 billion covert program channeled through the Pakistani Inter-Services Intelligence Directorate to factions of the Afghan Mujahideen. The financial architecture of Operation Cyclone required specific capabilities that the CIA's normal operational banking arrangements could not easily provide, moving large amounts of money across the borders of Pakistan, Afghanistan, Saudi Arabia, and the Gulf states without generating documentation that congressional oversight committees could examine, without creating paper trails that Soviet intelligence could follow, and without the involvement of Western financial institutions whose compliance procedures would generate the kind of records that investigations could later use. This was a logistical problem that required a specific kind of financial institution. BCCI had branches in Pakistan, in Saudi Arabia, in the UAE, in Oman, in Bahrain, in every country through which the money needed to move. It operated in local currencies without the correspondent banking relationships with American institutions that would have created American regulatory visibility. It had existing relationships with the ISI, the Pakistani intelligence service that was the operational conduit for CIA funds to the Mujahideen. Relationships that had been built over years of providing banking services to Pakistani military and government officials. And it had a structure specifically designed to prevent consolidated regulatory oversight. The CIA's use of BCCI for Operation Cyclone was not, according to the Kerry Committee's findings, a formal institutional arrangement in which the agency owned or controlled the bank. It was a more characteristic intelligence relationship, the use of an existing institution that had the operational capabilities the agency needed, managed through a combination of specific accounts, specific relationships with BCCI officers who understood what they were facilitating, and the implicit understanding that an institution performing services for American intelligence would receive a degree of protection from the regulatory scrutiny that might otherwise have examined its books. That implicit understanding is not documented in a single memo or formal agreement. It is documented in the pattern of what happened, in the CIA's knowledge of BCCI's criminal operations from at least 1983, in the agency's decision not to share that knowledge with regulatory authorities, in the Justice Department's interference with the Morgenthau investigation, and in the 5-year gap between when the CIA knew what BCCI was and when the bank was finally closed. The specific CIA accounts at BCCI were used for purposes that went beyond Operation Cyclone, though Afghanistan was the largest single program. The Kerry Committee identified BCCI accounts associated with covert operations in Central America, the period overlapping with the Iran-Contra affair, in which the CIA was also operating financial channels outside normal congressional oversight. Whether BCCI was directly used in the Iran-Contra financing is a question the documentary record does not definitively resolve, but the timeline, BCCI accounts being used for covert operations, BCCI's criminal activities being known to the CIA, the Iran-Contra period running from 1984 to 1986, makes the absence of any connection difficult to establish with confidence. What is established is that Manuel Noriega, the Panamanian military strongman who was simultaneously a CIA asset and one of the most significant narcotics trafficking facilitators in the Western Hemisphere, maintained accounts at BCCI. Noriega had been on the CIA payroll since at least the 1960s, providing intelligence and operational assistance for American programs in Latin America. His relationship with the agency survived his increasingly visible involvement in drug trafficking because, from the agency's perspective, his operational value outweighed the political cost of his activities, a calculation that held until the late 1980s, when the political cost finally became unmanageable. His BCCI accounts served multiple purposes simultaneously. They held proceeds from drug trafficking that BCCI laundered through its offshore banking operations. They also held payments from intelligence services that used Noriega as an asset, payments that passed through the same bank that was laundering his drug money in the same accounts, managed by the same officers who understood that their clients' activities were not questions they should ask about. This was the specific feature of BCCI that made it uniquely valuable to the range of actors who used it, the fact that it did not ask questions. An institution that moved money for the CIA and for the Colombian drug cartels and for Abu Nidal's terrorist organization was not doing these things because it had failed to notice the contradictions. It was doing them because its operational culture, established from the beginning by Abedi's specific vision of what the bank should be, treated the source and purpose of funds as matters outside its concern. Money was money. Relationships were relationships. The bank's job was to facilitate the movement of the former and maintain the latter. The CIA knew this by 1983, when the agency's own reporting established that BCCI was involved in money laundering, arms trafficking, and financial fraud at a scale that made it a significant criminal enterprise rather than merely a bank with some questionable clients. By 1986, according to Director Gates's Senate testimony, this knowledge was sufficiently detailed that the agency had a clear picture of BCCI's criminal operations. What the CIA did not do for 5 years after acquiring this knowledge was tell the people who might have acted on it. The explanation offered in the Kerry Committee hearings and in subsequent congressional testimony was operational. BCCI was too useful to expose. The accounts it held, the operations it facilitated, the relationships it maintained. These were assets that the agency was not prepared to sacrifice to regulatory accountability. The bank's criminal activities were, from the agency's perspective, a separate matter from its operational utility. The criminals who used BCCI were not the CIA's concern. The operations the CIA was running through BCCI were the CIA's concern, and those operations required the bank to remain open and functional. This was not a rogue position held by a small number of officers acting without institutional sanction. It was the considered judgment of an agency that had the information, had the authority to share it, and made a deliberate decision not to. The decision was made at levels of the institution that were aware of both the criminal activities and the operational uses, and that concluded the operational uses took precedence. The 20,000 Afghan Mujahideen fighters who received weapons funded through BCCI accounts in the 1980s did not know this. The 1.4 million depositors whose savings disappeared in 1991 did not know this. The families of the people killed by Abu Nidal's organization, which also used BCCI accounts to move its operational funds, did not know this. They learned it, to the extent they learned it at all, from 800 pages of Senate testimony published in 1992, in language precise enough to establish what had happened but carefully qualified enough to avoid the conclusions that the documented facts most directly supported. The roster of BCCI's clients reads like a directory of the most dangerous actors in the world between 1975 and 1991. It was not a coincidence, it was a business model. Abedi had understood from the earliest years of the bank's operation that the clients most willing to pay premium rates for financial services, without asking about documentation requirements, without demanding the compliance procedures that legitimate institutions required, and without generating the kind of relationship that created accountability in either direction, were precisely the clients that every other bank in the world had declined to serve. Drug traffickers needed to move money across borders without creating records. Arms dealers needed to receive payments in jurisdictions that did not report to the countries whose weapons export laws they were violating. Terrorist organizations needed operational funds that could not be traced back to their state sponsors. Intelligence agencies needed accounts that did not appear on any document that congressional oversight committees had access to. BCCI served all of them, not sequentially, not in separate compartments, but simultaneously in the same institution, often in the same branches, managed by officers who understood that their professional advancement depended on their ability to attract and retain exactly this category of client. Manuel Noriega's relationship with BCCI was the most extensively documented of the bank's criminal client relationships, partly because his subsequent prosecution in the United States required the introduction of financial records into evidence that established the nature of his accounts in detail. Noriega had been moving money through BCCI since the early 1980s. The accounts were held in Panama, in Luxembourg, and in the Cayman Islands, a geographic distribution that itself illustrated the bank's utility as a money laundering vehicle, since moving funds between these jurisdictions through BCCI generated no consolidated record that any single regulatory authority could examine. The money in those accounts came from multiple sources: payments from the CIA for his intelligence services, payments from the Colombian Medellin cartel for providing Panamanian territory and infrastructure as a transshipment point for cocaine moving toward the United States, and various forms of graft and corruption from his control of the Panamanian state. The CIA payments and the drug money sat in the same bank. In some cases, they sat in accounts managed by the same officers. The people at BCCI who processed Noriega's transactions knew, in the general sense, that people in that institutional culture understood these things, that their client was a military dictator with multiple income streams of uncertain legality. This knowledge did not create any compliance response within the institution, because the institution had not been designed to generate compliance responses to this kind of knowledge. When Noriega was indicted in Miami in February 1988 on drug trafficking charges, the indictment included references to his BCCI accounts. This was the first time that BCCI's name appeared in a major American criminal proceeding in connection with high-level money laundering. It did not produce an immediate investigation of the bank. The Justice Department's response was focused on Noriega, a target whose prosecution served clear policy purposes as the Reagan administration's relationship with its former Panamanian asset had deteriorated, rather than on the financial institution that had held his money and the money of dozens of other clients with equally problematic profiles. The Abu Nidal organization's use of BCCI was documented in the Kerry Committee report and in subsequent investigative journalism, and it illustrated a dimension of the bank's client relationships that went beyond money laundering into the direct facilitation of political violence. Abu Nidal, born Sabri Khalil al-Banna, ran what was, during the 1970s and 1980s, one of the most active and lethal Palestinian rejectionist terrorist organizations in the world. His organization was responsible for attacks across Europe, the Middle East, and Asia that killed hundreds of people, including the simultaneous attacks on the Rome and Vienna airports in December 1985 that killed 19 people and wounded more than 100. Abu Nidal's organization was for hire. It conducted operations on behalf of state sponsors including Iraq, Libya, and Syria, depending on which government was paying at any given time. The operational funding for these activities moved through BCCI. The specific BCCI accounts used by the Abu Nidal organization were identified in the Kerry Committee investigation and in British intelligence reporting that was shared with American authorities. The accounts were held in multiple jurisdictions and managed in ways that separated the operational funds from any traceable connection to the state sponsors who provided them. BCCI's structure, its fragmented regulatory geography, its culture of non-inquiry, its officer network trained to facilitate rather than question, made it a natural fit for an organization whose operational security depended on financial invisibility. The fact that the CIA knew about BCCI's criminal activities by 1983 to 1986, and that Abu Nidal's organization was using BCCI accounts during this same period, creates a specific historical question that the Kerry Committee identified but could not definitively answer. Did the CIA's decision to protect BCCI from regulatory exposure contribute to the operational capability of a terrorist organization that was killing civilians in Western cities? The documentary record does not contain a memo in which a CIA official weighed the value of BCCI's covert operation utility against the cost of Abu Nidal's continued access to BCCI's banking services and concluded that the former outweighed the latter. What the record contains is the outcome. The agency knew, did not act, and the bank remained open, from which the logical implications are available to anyone willing to follow them. The Colombian cartel connections were documented through a separate investigative track that originated with U.S. Customs rather than the CIA or the Justice Department. Operation Sea Chase was an undercover operation run by U.S. Customs beginning in 1986, in which an undercover agent named Robert Musella penetrated BCCI's Tampa, Florida branch by presenting himself as a money launderer seeking banking services for drug proceeds. Over 2 years, Musella built a relationship with BCCI officers who provided him with a comprehensive money laundering service, structuring cash deposits to avoid reporting requirements, moving funds through offshore accounts, providing documentation that obscured the origin of the money. The operation produced videotaped evidence of BCCI officers discussing, in explicit terms, how to launder drug money through the bank's international network. It produced financial records tracing the movement of funds through accounts in Panama, in Luxembourg, in the Cayman Islands. It produced, in short, the kind of evidentiary foundation that criminal prosecutors consider a strong case. In October 1988, U.S. Customs executed its arrests. 11 BCCI officers and employees were charged in Tampa with money laundering and conspiracy. The bank itself was charged as an institution. The case was prosecuted in Tampa by the Justice Department. The Tampa prosecution resulted in guilty pleas and convictions. BCCI paid a fine of $14 million. The Tampa case was resolved in January 1990. What the Tampa prosecution did not do was open the door to a comprehensive investigation of BCCI as a global criminal enterprise. The Justice Department's handling of the Tampa case, the decision to resolve it through a plea agreement that imposed a financial penalty without requiring full disclosure of the bank's operations, without pursuing the senior leadership, without opening the bank's records to the kind of examination that would have revealed what Morgenthau's investigation would later begin to uncover, was a decision that kept the investigation narrow, kept the resolution manageable, and kept the larger picture out of the public record. Whether this narrowness was the product of prosecutorial conservatism, of institutional coordination with the CIA to limit exposure of covert operations, or of some combination of the two, was a question that the Kerry Committee examined at length and answered with the careful language of investigators who had established enough to be disturbing but not quite enough to be definitive. What was definitive was the outcome. BCCI paid $14 million. Its Tampa officers went to prison. Its global operations continued. Its CIA accounts remained active. Its Abu Nidal accounts remained active. Its Noriega accounts remained active. And Robert Morgenthau in New York was just beginning to understand what he was actually looking at. In 1978, BCCI secretly purchased a controlling interest in Financial General Bank shares, a Washington, D.C. bank holding company that controlled financial institutions across Virginia, Maryland, Tennessee, and New York. The purchase was illegal under American law. Federal banking regulations prohibited foreign entities from acquiring American banks without prior approval from the Federal Reserve. The approval process existed specifically to allow regulators to examine the source of the acquiring institution's funds, the nature of its ownership structure, and the suitability of its management, exactly the kind of examination that would have revealed what BCCI was had it been applied. Abadi's solution to this regulatory obstacle was characteristic of his approach to every regulatory obstacle he encountered. He did not attempt to circumvent the rule directly. He restructured the acquisition so that the rule did not appear to apply. The mechanism was nominee ownership. Rather than having BCCI acquire Financial General Bank shares directly, Abadi arranged for the purchase to be made by a group of wealthy Middle Eastern investors, prominent figures from Saudi Arabia, Abu Dhabi, and other Gulf states, who would hold the shares in their own names while operating under agreements that gave BCCI effective control over how those shares were voted and how the bank was managed. On paper, the acquisition was a legitimate investment by a group of individual foreign nationals, each of whom was wealthy enough that their purchase of bank shares was not inherently suspicious. The Federal Reserve's approval process focused on the individual investors, who presented themselves as independent actors, rather than on the institution that was actually directing the acquisition. The Federal Reserve approved the transaction. Financial General Bankshares was subsequently renamed First American Bankshares. It became the largest bank holding company in Washington, D.C., with assets that eventually reached roughly $10 billion and a network of branches serving the political, legal, and business communities of the American capital. To run it, Abedi recruited Clark Clifford. Clifford was, in 1978, one of the most distinguished figures in the American foreign policy establishment. He had served as special counsel to President Truman, had been a senior advisor to Presidents Kennedy and Johnson, and had served as Secretary of Defense under Johnson from 1968 to 1969. He was 71 years old when he took the chairmanship of First American, and his reputation, built over 3 decades of proximity to American presidential power, was precisely the asset that Abedi was acquiring when he recruited him. Clifford's role was to provide the institutional legitimacy that BCCI's actual ownership could not supply. When regulators asked questions about First American, they were dealing with Clark Clifford, a man whose name was synonymous, in the Washington of that era, with the highest traditions of American public service. When congressional figures or journalists raised concerns, Clifford's presence at the top of the institution served as a rebuttal that required no argument. The question of whether the bank was properly managed answered itself with his name on the letterhead. Clifford's law partner, Robert Altman, served as president of First American and managed the day-to-day relationship with BCCI. Altman was 40 years younger than Clifford, a skilled corporate lawyer who had married the actress Linda Carter and who moved through Washington's social and professional networks with the ease of someone who had understood early that proximity to power was itself a form of capital. The arrangement that Clifford and Altman maintained with BCCI was, they would later claim, one they did not fully understand. They insisted that they had not known that the Middle Eastern investors who nominally owned First American were acting as nominees for BCCI, and that they had genuinely believed they were running an independent institution whose Gulf state shareholders happened to have relationships with the Pakistani bank. They maintained this position through years of regulatory inquiry, congressional investigation, and criminal prosecution. The Federal Reserve, when it finally began to examine the First American acquisition seriously in 1990, 12 years after the transaction, concluded that the nominee structure had been deliberately designed to conceal BCCI's control, and that the concealment had been successful precisely because the people at the visible top of the institution provided a credible alternative explanation for every question that the structure raised. The specific moment at which BCCI's control of First American became visible to American regulators was not the result of a regulatory examination or an intelligence disclosure. It was the result of a lawsuit. In 1990, a legal dispute involving BCCI's operations produced court filings in the United Kingdom that contained documents establishing the true ownership structure of First American. These documents reached the Federal Reserve through the ordinary process of international regulatory communication. When Fed examiners read them, they understood immediately what they were looking at, and they understood that the institution had been operating in violation of American banking law for 12 years, in plain sight, in the capital of the United States, chaired by one of the most prominent figures in the American foreign policy establishment. The Federal Reserve's investigation of the First American acquisition produced a civil action that resulted in BCCI's formal acknowledgement that it had illegally controlled First American and the payment of a $200 million fine. Clark Clifford and Robert Altman were referred for criminal prosecution. The criminal case against Clifford and Altman in New York, brought by Morgenthau's office, was one of the most closely watched white-collar prosecutions of the early 1990s. Altman was tried and acquitted in 1993. The jury found the evidence insufficient to establish that he had knowingly participated in the fraud rather than being deceived by BCCI's principles. Clifford was indicted alongside Altman but was never tried. His lawyers successfully argued that his health, he had undergone heart surgery and was in his late 80s, made him unable to withstand a criminal trial. He died in 1998 without having faced a jury. The question that the First American case raised, and that the prosecutions did not answer, was not primarily about Clifford and Altman. They were, in an important sense, the visible surface of a structure that ran much deeper. The question was about the Federal Reserve, about how an illegal acquisition of the largest bank holding company in Washington, D.C. had remained undetected for 12 years, during a period when the CIA had information about BCCI's criminal operations that should have prompted exactly the kind of examination that would have found the First American connection. The Federal Reserve's examiners had approved the original acquisition. They had conducted routine examinations of First American during the 12 years of BCCI's illegal control. They had not found what was there to be found, not because the evidence was inaccessible, but because no one had told them where to look. The CIA had known where to look since at least 1983. A CIA officer with access to the agency's BCCI reporting in the mid-1980s would have known that the bank was operating an illegal ownership structure in the United States, that it had acquired a major Washington bank through nominee shareholders, and that the chairman of that bank was Clark Clifford, a man with decades of access to the senior levels of American government, including the intelligence community. What that officer would have done with that knowledge, within an agency that had concluded that BCCI's operational utility outweighed the cost of exposure, is a question whose answer the documentary record approaches but does not fully reach. What the record does reach is the outcome. BCCI controlled the largest bank in Washington, D.C. for 12 years. During those 12 years, First American's accounts served the financial needs of the political, legal, and lobbying communities of the American capital. The extent to which BCCI's control of First American provided intelligence value to the bank's principals, access to financial information about American political figures, relationships with Washington insiders that could be exploited for influence, a window into the financial activities of the government institutions that BCCI most needed to remain uninvestigated, was a question that the Kerry Committee raised and was unable to fully answer because the documents that would have answered it were held by agencies whose cooperation with the investigation was limited by the same institutional interests that had protected BCCI for a decade. Clark Clifford's reputation did not survive the investigation intact. The man who had been the model of the Washington establishment lawyer, the trusted advisor, the discreet counselor, the figure whose integrity was assumed by everyone who dealt with him, spent the last years of his life under indictment, publicly associated with the largest bank fraud in history, defending himself against charges that his most prominent defenders insisted he could not have knowingly committed. Whether he knew or did not know is a question that his death and his acquitted partner's silence have left permanently open. What is not open is the larger question. BCCI was inside Washington. It was chaired by a former Secretary of Defense. It held accounts and relationships at the center of American political life for 12 years. And the agency that knew what it was had decided, for reasons that served its operational interests, that this was not information the American public or its regulatory institutions needed to have. Robert Morgenthau had been the Manhattan District Attorney since 1975. He was the son of Henry Morgenthau, Jr., who had served as Franklin Roosevelt's Treasury Secretary, and who had spent years trying to alert the American government to the scale of the Holocaust, while State Department officials managed the information to minimize political inconvenience. The elder Morgenthau had learned, in the most consequential possible context, what it looked like when government institutions chose not to act on information they possessed. His son had inherited both the prosecutorial instinct and the specific suspicion of institutional non-engagement that the family history made almost inevitable. By 1989, Robert Morgenthau had been watching BCCI from the margins of the Tampa prosecution for a year. What he had seen in the Tampa case was a resolution that, in his assessment, bore the characteristics of a deliberate limitation, a prosecution calibrated to address a specific and manageable set of charges, while leaving the larger institutional structure untouched. The $14 million fine, the guilty pleas from mid-level officers, the absence of any examination of BCCI's senior leadership or its global accounts. These were the features of a case that had been resolved in a way that closed a file rather than opened an investigation. Morgenthau's office opened its own investigation of BCCI in 1989. The jurisdictional basis was straightforward. BCCI had operations in New York, had conducted transactions through New York financial institutions, and had clients whose activities fell within the Manhattan DA's geographic reach. The legal theory was not exotic. The evidence that the Tampa prosecution had already produced established the basic criminal conduct. What Morgenthau wanted was the complete picture, the global accounts, the senior leadership, the institutional mechanisms that had allowed the bank to operate as a criminal enterprise across 73 countries for nearly 2 decades. To get the complete picture, he needed documents and cooperation from the Justice Department. What he received instead was a sustained pattern of interference that he would later describe in testimony before the Kerry Committee as the most significant obstruction he had encountered in his career as a prosecutor. The specific forms of the interference were bureaucratic rather than dramatic. The Justice Department did not issue a formal order telling Morgenthau to stop. It did not file legal motions to shut down his investigation. What it did was slower and more effective. It declined to share documents that its own investigations had produced. It raised jurisdictional objections to specific investigative steps that Morgenthau's office proposed, It communicated through the ordinary channels of interagency coordination that the Manhattan DA's approach was creating complications for federal investigations that were ongoing, and it consistently failed to respond to requests for information with the urgency that the investigation required. John Moscow, the assistant district attorney who ran the BCCI investigation for Morgenthau's office, later described the experience of dealing with the Justice Department during this period as operating against a current that had no obvious source. Every specific request encountered a specific obstacle. Every specific obstacle was explicable in procedural terms that were individually plausible and collectively inexplicable, unless they were the product of a coordinated effort to limit the investigation's scope. The coordinated effort the Kerry Committee would eventually establish had a source. In 1989 and 1990, while Morgenthau's investigation was being managed by the Justice Department's procedural obstacles, the CIA was providing the Justice Department with assessments of BCCI that characterized the bank primarily as an asset rather than a target. Internal CIA communications from this period, portions of which were released in response to Kerry Committee requests, described BCCI in terms that emphasized its operational utility for American intelligence programs and that recommended a cautious approach to any investigation that might disrupt those programs or expose the accounts associated with them. The Justice Department's Criminal Division, which oversaw the federal BCCI prosecution, received CIA input on the case through the interagency channels that connected the national security apparatus to law enforcement. The precise mechanism by which that input shaped the Criminal Division's decisions about Morgenthau's investigation is not fully documented in the available record. What is documented is the temporal correlation, CIA assessments recommending caution, Justice Department behavior consistent with caution, Morgenthau's investigation proceeding at a pace and scope that the available evidence did not require. Richard Thornburg, who served as Attorney General from 1988 to 1991, was questioned before the Kerry Committee about the Justice Department's handling of BCCI. His testimony was careful, technically precise, and ultimately uninformative about the specific decisions that had shaped the department's approach to Morgenthau's investigation. He acknowledged that the department had been aware of the Tampa prosecution's limitations. He acknowledged that BCCI had been a subject of ongoing federal attention. He did not acknowledge that the federal attention had been calibrated to prevent the kind of comprehensive examination that Morgenthau was attempting. William Barr, who succeeded Thornburg as Attorney General in late 1991, after the bank had been closed and after Morgenthau's investigation had produced enough to make comprehensive avoidance no longer possible, testified before the Kerry Committee in ways that were somewhat more forthcoming about the department's institutional posture toward BCCI, while maintaining that the decisions made had been defensible on prosecutorial grounds. The Kerry Committee's assessment of the Justice Department's conduct was unsparing in its conclusions and careful in its language. The report stated that the department had failed to respond adequately to BCCI's criminal operations, had been slow to pursue investigative leads that were available to it, and had not shared information with state prosecutors in ways that would have accelerated the exposure of the bank's activities. It stopped short of characterizing this failure as deliberate obstruction in the criminal sense. The evidentiary standard for that conclusion was higher than the documented record reached. But the committee's language made clear that the failure was not the product of incompetence or resource constraints. It was the product of institutional choices made by people who understood the implications of those choices. The specific moment at which the Justice Department's management of the BCCI situation became untenable was July 5, 1991, the simultaneous shutdown. The shutdown had been coordinated by the Bank of England, working with the Luxembourg Banking Commission and the Abu Dhabi government, which had become the bank's dominant shareholder after a restructuring in the late 1980s. The Abu Dhabi authorities had commissioned an audit by Price Waterhouse that finally produced in 1991 a report documenting the true scale of BCCI's fraudulent accounting. That report went to the Bank of England. The Bank of England organized the coordinated closure. The United States Justice Department was informed of the planned closure in advance. Morgenthau's office was not informed. The day after the shutdown, Morgenthau held a press conference at which he described the Justice Department's handling of BCCI as a disaster. He said his office had been trying for 2 years to get documents and cooperation that would have allowed a comprehensive case to be built before the bank's assets disappeared. He said the federal government had not been a cooperative partner in that effort. He said the people responsible for the bank's operation needed to be prosecuted to the fullest extent of the law, and that he intended to pursue that prosecution from New York regardless of what the federal government did. His investigation produced the criminal case against Aga Hassan Abedi, against Swala Naqvi, who had been BCCI's chief operating officer, against Clark Clifford and Robert Altman, and against a range of other individuals whose conduct fell within New York jurisdiction. It produced guilty pleas, convictions, and the most comprehensive public accounting of BCCI's operations that any legal proceeding generated. It did not produce the prosecution of a single CIA officer. It did not produce the disclosure of the CIA accounts. It did not produce a formal accounting of the covert operations that had been funded through BCCI's network, the identities of the individuals those operations had supported, or the specific decisions made within the agency about when and how to protect the bank from the regulatory examination that might have exposed them. Those things remained where they had been placed, in classified files, in the institutional memory of an agency whose cooperation with the Kerry Committee had been sufficient to establish the outlines of what had happened without providing the specificity that would have made the full accounting possible. Morgenthau had gotten further than anyone else. He had gotten close enough to see the shape of what was there. He had not gotten all the way in. The door that would have let him in the rest of the way was held closed by the same institutional hands that had been holding it closed since 1983. The Kerry Committee was not supposed to be a BCCI investigation. Senator John Kerry of Massachusetts had convened the Subcommittee on Terrorism, Narcotics and International Operations in 1987 to examine the relationship between drug trafficking and the Contra program in Nicaragua, the covert American effort to fund and arm the anti-Sandinista resistance that had become, through the Iran-Contra revelations, the most politically damaging intelligence scandal of the Reagan years. The subcommittee's original mandate was focused on Central America. BCCI entered its field of vision gradually, as investigators following the money trails of Iran-Contra and the Contra drug connections kept arriving at the same institution. By 1989, Kerry's staff had established that BCCI was not peripheral to the questions they were investigating. It was central to them. The bank appeared at the intersection of every covert financial network they were tracing: the Contra supply operations, the Noriega accounts, the arms deals, the drug money. The subcommittee expanded its investigation accordingly, and what began as an inquiry into Central American drug trafficking became, over 3 years, the most comprehensive examination of BCCI's operations that any government body would conduct. Kerry was an unusual figure for this kind of investigation. He was in his first term as a senator, 43 years old, a Vietnam veteran who had become famous, and in some circles infamous, for his anti-war testimony before the Senate Foreign Relations Committee in 1971. He was not a member of the senior establishment of the Senate Intelligence Committee, which had formal oversight responsibility for CIA operations, and which was, in the culture of the institution, more protective of the agency's operational equities than a freshman senator running a subcommittee on narcotics trafficking. His position outside the intelligence oversight structure was, in practice, an advantage. He did not have the institutional relationships with the CIA that would have created the informal pressures to limit the investigation's scope. His chief investigator was a former DEA agent named Jack Blum, who had been following the intersection of drug money and covert operations since the mid-1980s and who brought to the investigation both specific knowledge of how those intersections worked and a prosecutorial instinct that was not satisfied by the kind of careful institutional non-conclusions that oversight investigations typically produced. The CIA's cooperation with the Kerry Committee was, from the beginning, managed in ways that produced the appearance of engagement without the substance of disclosure. The agency provided witnesses, it provided documents. The witnesses answered questions within carefully defined parameters that their agency counsel enforced in real time during testimony. The documents arrived with redactions that removed the specific details, names, account numbers, operational code names, that would have allowed investigators to follow the evidentiary chains to their conclusions. Robert Gates appeared before the subcommittee in 1992, after the shutdown, in his capacity as CIA director. His testimony on BCCI was the most significant public acknowledgement the agency made of its relationship with the bank, and it established several facts that the agency could not plausibly deny given the documentary record that Morgenthau's investigation and the Kerry Committee's own work had assembled. Gates acknowledged that the CIA had been aware of BCCI's criminal activities since 1986. He acknowledged that this awareness had not been shared with regulatory authorities at the time. He offered the explanation that the agency's information about BCCI had been compartmented, held within specific operational programs rather than shared across the institution, and that the people responsible for sharing relevant financial intelligence with regulatory bodies had not had access to the BCCI reporting that other parts of the agency possessed. The compartmentation explanation was technically plausible and institutionally convenient. Intelligence agencies do compartment information, and the failure of information to flow between compartments is a genuine and recurring problem in large bureaucratic organizations. But the Kerry Committee's investigators were skeptical, and their skepticism was grounded in a specific evidentiary problem with the compartmentation account. The decisions that had protected BCCI from regulatory scrutiny, the Justice Department's management of the Morgenthau investigation, the Tampa prosecution's careful limitation, the Federal Reserve's 12-year failure to examine First American, were not the product of passive information failures. They were the product of active institutional choices. Passive compartmentation failures do not produce active obstruction. They produce nothing, which is a different outcome. The committee's report, published in December 1992, ran to nearly 800 pages. It was titled simply The BCCI Affair, and it remains the most detailed public account of the bank's operations and the American government's relationship with them that has ever been assembled in a single document. Its findings were organized around a set of conclusions that the evidence supported, and that the committee's language rendered with the precision of people who understood that every word would be examined by the institutions whose conduct they were describing. The report found that BCCI had been a fundamentally criminal enterprise from its earliest years of significant operation. It found that the bank had been used by the CIA for covert operations, including the funding of the Afghan Mujahideen through ISI Pakistan. It found that Manuel Noriega, Abu Nidal, and the Colombian drug cartels had all maintained accounts at BCCI and had used those accounts for criminal purposes that BCCI's officers had facilitated knowingly. It found that BCCI had illegally acquired First American Bank shares and had concealed that acquisition through nominee ownership for 12 years. It found that Clark Clifford and Robert Altman had either knowingly participated in that concealment or had been deceived by BCCI's principals in ways that a more careful exercise of their professional responsibilities would have prevented. On the central question of the CIA's conduct, the report's language was measured in a way that the underlying facts did not require. The committee found that the CIA had been aware of BCCI's criminal activities since 1986 and had not reported that awareness to regulatory authorities. It found that this failure had contributed to the bank's continued operation during years in which depositors were losing money and criminal clients were using its facilities. It found that the Justice Department's handling of BCCI investigations had been inadequate in ways that a more aggressive prosecutorial posture would have corrected. What the report did not find, or more precisely, what it did not state in the declarative language that would have made it a direct indictment of institutional conduct, was that these failures were the product of deliberate coordination between the CIA and the Justice Department to protect a criminal institution because that institution was operationally useful. The evidence supported that conclusion. The committee's language approached it without quite arriving there. The reason for the gap between the evidence and the conclusion was not epistemic, it was institutional. Kerry and his colleagues understood that a Senate subcommittee finding that the CIA had deliberately obstructed federal law enforcement to protect a criminal bank would create a political and legal situation that no one in the Senate leadership was prepared to manage. It would require responses, investigations, prosecutions, institutional reforms that would consume years of political capital and produce confrontations with the intelligence community that the Senate, as an institution, was not willing to initiate on the basis of a subcommittee report. The report was published. It received substantial press coverage for several weeks. It was discussed on editorial pages and in congressional hearing rooms. It produced no criminal charges against any CIA officer. It produced no formal investigation of the CIA's decision to withhold its BCCI reporting from regulatory authorities. It produced no institutional reform of the mechanisms through which the intelligence community communicated financial intelligence to the regulatory bodies responsible for the banking system. Aga Hassan Abedi had suffered a severe stroke in 1990 and was effectively incapacitated. He was indicted in absentia by Morgenthau's office on charges that included racketeering, fraud, and conspiracy. He remained in Pakistan, which declined to extradite him, under the medical supervision that his lawyers maintained made his prosecution impossible. He died in Karachi in August 1995, having never faced a jury in any jurisdiction. Swala Naqvi, BCCI's chief operating officer, was extradited from Abu Dhabi in 1994 and pleaded guilty in Washington to charges of racketeering, fraud, and obstruction. He was sentenced to 11 years in prison and served a portion of that sentence before being released. The Abu Dhabi government, which had been BCCI's largest shareholder through Sheikh Zayed's investment, and which had commissioned the Price Waterhouse audit that triggered the shutdown, reached a civil settlement with regulators that provided some recovery for depositors. The settlement covered a fraction of the losses. The 1.4 million depositors who had trusted the bank with their savings received varying degrees of recovery depending on which jurisdiction held their accounts and how the liquidation process in that jurisdiction was managed. Many received nothing. The small depositors in Pakistan, India, Bangladesh, and across Africa and Asia, the people whom Abedi had originally described as the bank's core constituency, the underserved communities of the developing world, recovered the least. They had been, from the beginning, the institutional justification for a bank whose actual primary clients had never been the people the justification named. There is a passage in the Kerry Committee report that has received less attention than its factual findings, but that contains, in compressed form, the essential judgment that the 800 pages of documented evidence support. It appears near the end of the report, in the section addressing lessons learned, and it reads, "In the careful, institutionally aware language that Senate committee reports employ when they want to say something serious without triggering the political consequences of saying it directly, that the BCCI affair demonstrated the existence of a fundamental tension between the operational requirements of American intelligence agencies and the legal and regulatory framework within which the American financial system was supposed to operate, and that this tension had been resolved repeatedly and consistently in favor of the operational requirements." This was not a finding about a single decision or a single official. It was a structural finding, a conclusion about how a system had operated over time, across multiple agencies, through multiple administrations, producing consistent outcomes that served specific institutional interests at the expense of the depositors, the law enforcement officers, the regulatory bodies, and the foreign governments whose cooperation had been compromised by the bank's continued operation. The structural finding was the important one, and it has remained the least examined. The specific scandals that BCCI produced, the Noriega accounts, the first American acquisition, the Clifford and Altman prosecution, the CIA's 5-year silence, were examined, reported, litigated, and resolved in the ways that the American legal and political system resolves such things, partially slowly with outcomes calibrated to what the institutional actors involved were willing to accept rather than to what the documented facts required. What was not resolved and what has not been resolved in the 3 decades since the Kerry Committee report was published is the structural question that the report identified. The question of how intelligence agencies use the international financial system for covert operations, how that use creates institutional interests in protecting criminal financial institutions from regulatory scrutiny, and how those interests are managed in relation to the legal framework that governs the financial system. This question was identified in 1992, documented in 800 pages of evidence, and then set aside in the way that structural questions tend to be set aside when answering them would require confronting the institutions whose interests the current arrangement serves. The blueprint that BCCI established did not disappear with the bank. The specific mechanisms that made BCCI useful, offshore incorporation in secrecy jurisdictions, nominee ownership structures, the use of correspondent banking relationships to move money across borders without consolidated regulatory visibility, the cultivation of relationships with intelligence agencies that created protection from examination. These mechanisms did not become unavailable when BCCI's doors closed in July 1991. They became, if anything, more widely understood and more widely applied because the BCCI affair had demonstrated their effectiveness with the precision of a case study. The financial infrastructure of the September 11 attacks, which moved money through a network of hawala dealers, offshore accounts, and correspondent banking relationships across multiple jurisdictions, bore structural similarities to the BCCI network that investigators noted at the time and that the 9/11 Commission documented in its financial annex. The similarities were not coincidental. The people who designed the 9/11 financing had operated in the same financial environment as BCCI, had used some of the same jurisdictions, and in some cases had connections to the same networks that BCCI had served. The post-9/11 period produced substantial reforms to international anti-money laundering frameworks. The Financial Action Task Force standards were strengthened. The Bank Secrecy Act was expanded by the USA Patriot Act. Correspondent banking relationships became subject to more intensive scrutiny. These reforms were real, and they mattered. They raised the cost of the specific mechanisms that BCCI had exploited. They did not address the structural question that the Kerry Committee had identified. The question of what happens when an intelligence agency concludes that its operational requirements justify using financial institutions that are engaged in criminal activity, and who is accountable when that decision produces the outcomes that BCCI produced. That question has been answered by subsequent events in ways that are consistent with the answer BCCI provided. The institutions that make the decision, the intelligence agencies, the Justice Department components that coordinate with them, are not accountable to the regulatory bodies whose oversight they circumvent. They are accountable in theory to congressional oversight committees and in practice to the internal oversight mechanisms of their own institutions and to the political appointees who lead them. When those internal mechanisms and those political appointees conclude that the operational requirements justify the decision stands. The depositors, the law enforcement officers, the foreign governments, and the victims of the criminal organizations that use the protected institutions are not parties to this decision. They experience its consequences without having any formal role in making it. The 1.4 million people who lost money in BCCI were not compensated by the CIA, whose decision to protect the bank from regulatory scrutiny had contributed to the extension of its operation and therefore to the scale of the losses. They were not compensated by the Justice Department, whose management of federal investigations had produced outcomes calibrated to institutional interests rather than depositor protection. They received whatever the liquidation process in their jurisdiction produced, which in most cases was a fraction of their deposits, and in many cases nothing. The CIA officers who had managed the BCCI accounts, who had written the internal reports documenting the bank's criminal activities, who had participated in the institutional decision not to share that information with regulatory authorities. None of them were identified publicly. None of them were prosecuted. None of them faced institutional consequences of any kind that entered the public record. They retired on schedule, collected their pensions, and watched the Kerry Committee hearings from whatever distance their institutional positions afforded them. Robert Morgenthau continued as Manhattan District Attorney until 2009, completing 35 years in the office. He gave interviews about BCCI throughout his later career, describing it consistently as the most significant financial crime he had investigated and the most significant example of federal obstruction he had encountered. He said in an interview late in his tenure that the full story of BCCI had never been told because the full story required access to documents and information that the CIA had never provided and that no legal mechanism had ever successfully compelled. He was right about that, and he knew precisely why he was right. John Kerry left the Senate in 2013 to become Secretary of State. His work on the BCCI committee is a footnote in the official biography, mentioned in accounts of his Senate career with the kind of brief acknowledgement that important work receives when it produced documentation without producing the accountability that the documentation required. The 800-page report that his committee produced is available in the public record, accessible to anyone who wants to read it, cited in academic literature on financial crime and intelligence oversight, and essentially absent from the mainstream historical understanding of what American foreign policy looked like in the 1980s. The bank is gone, the accounts are closed, the officers are dead or retired, the depositors have absorbed their losses and moved on, as people who have absorbed losses and have no recourse tend to move on. What remains is the structure, the set of institutional relationships, legal arrangements, and operational cultures that made BCCI possible and that the BCCI affair documented without dismantling. Secrecy jurisdictions still exist. Nominee ownership structures are still used to conceal the beneficial ownership of financial institutions and corporations. Intelligence agencies still have operational requirements that create incentives to use financial institutions that regulatory scrutiny would examine. The coordination mechanisms between intelligence agencies and law enforcement that shaped the Justice Department's handling of the Morgenthau investigation are still in place, still governed by the same institutional cultures that produced that handling. The specific bank is gone, the blueprint it provided is not. Agha Hassan Abedi had understood when he designed BCCI that the international financial system's fragmented regulatory geography created opportunities that a sufficiently sophisticated institution could exploit indefinitely. He was wrong about the indefinitely. The bank lasted 19 years before the gaps were closed around it. But he was right about the opportunity, and the opportunity existed not because the regulators were incompetent, not because the legal frameworks were absent, but because the system had a specific feature that his institution had been designed to exploit. That feature was the gap between the legal rules that governed financial institutions and the operational interests of the governments whose agencies those institutions served. In the space of that gap, $20 billion moved, intelligence operations ran, dictators banked, terrorists transferred funds, drug money was laundered into legitimate assets, and the people responsible for closing the gap, the regulators, the law enforcement officers, the congressional investigators, found that every time they approached it, there was an institutional reason why this particular gap at this particular moment needed to remain open a little longer. The gap is still there. It is smaller than it was in 1991. The reforms of the intervening decades have reduced it. The post-9/11 financial surveillance infrastructure has made it harder to use. The international anti-money laundering frameworks have raised the cost of exploiting it. But the institutional interests that kept it open in 1983 and in 1986 and in 1989 and on every morning between those years and July 5, 1991 when the doors finally closed, those interests have not changed. They are the permanent feature of a system in which the agencies responsible for covert operations and the agencies responsible for financial regulation share a government but not a set of priorities, and in which the mechanisms for resolving the conflicts between those priorities have consistently produced the same answer. The operations come first. The depositors come later. The accounting, if it comes at all, comes last. 800 pages, carefully worded, available in any library, read by almost no one, changing almost nothing.